Real estate investing is one of the best ways to build wealth, but taxes can eat into your profits if you're not careful. That's where a 1031 exchange comes in. It's a powerful tool that lets you defer capital gains taxes when you sell one investment property and replace it with another. Today, we're going to break it down step by step, so you understand how it works and how it can help you grow your real estate portfolio. A 1031 exchange, named after Section 1031 of the IRS tax code, is essentially a trade. You sell one property and use the proceeds to buy another, but instead of paying taxes on the sale, you defer them. This gives you more money to reinvest and allows your wealth to grow faster. It's a simple concept, but there are rules you need to follow to make it work. First, the properties involved must be like-kind. That doesn't mean they have to be identical, but they do need to be used for investment or business purposes. For example, you could exchange a rental house for an apartment building or a strip mall. You can't, however, use a 1031 exchange to sell an investment property and buy a vacation home for personal use. The key is that both properties must be used for income, business, or investment. Timing is another crucial factor. Once you sell your property, you have 45 days to identify potential replacement properties. These must be listed in writing and submitted to a qualified intermediary. After that, you have 180 days to close on one of those properties. These deadlines are strict, and missing them will disqualify your exchange, so planning is essential. A qualified intermediary, or QI, is required for all 1031 exchanges. They hold the proceeds from the sale of your original property and use them to purchase the replacement property on your behalf. This ensures you don't touch the money, which is critical for maintaining the tax-deferred status of the exchange. Choosing a reliable QI is one of the most important steps in the process. The value of the replacement property must be equal to or greater than the property you sold. If it's less, you'll have to pay taxes on the difference. This is known as boot, and it's something you want to avoid if you're aiming for a fully tax-deferred exchange. For many investors, this means reinvesting all proceeds from the sale, not just part of them. 1031 exchanges aren't just for individual properties. You can also use them for portfolios or even partial interests in larger investments like real estate syndications or Delaware statutory trusts. This flexibility allows investors to diversify and scale their portfolios in ways that might not be possible otherwise. It's about using your equity strategically to achieve your long-term goals. One of the biggest advantages of a 1031 exchange is the ability to trade up. Many investors use this strategy to move from smaller, less profitable properties to larger ones with higher returns. For example, you might sell a single-family rental and use the proceeds to buy a multi-unit building. This can increase your cash flow, build equity faster, and position you for even bigger opportunities down the road. 1031 exchanges also provide a way to consolidate or diversify your investments. Maybe you own several small properties and want to consolidate them into one larger, easier-to-manage asset. Or perhaps you're looking to diversify by exchanging one property for several in different markets. Either way, a 1031 exchange can help you restructure your portfolio without triggering immediate tax consequences. Now, let's talk about legacy planning. A 1031 exchange doesn't eliminate taxes, it defers them. However, if you hold on to the property until you pass away, your heirs can inherit it at its stepped-up market value. This effectively eliminates the deferred taxes, making 1031 exchanges a powerful tool for building generational wealth. There are risks to consider. If the replacement property doesn't perform as expected, or if the market takes a downturn, you could end up with less equity than you started with. That's why it's essential to work with experts who understand the market, including property managers like Alpine Property Management Kansas City, to help you maximize your investment. Speaking of investments, if you're dealing with a problem property that doesn't fit into your plans anymore, Alpine Property Management Kansas City can help. We buy houses, no matter the condition or circumstances. If you're ready to move on from a property that's become more trouble than it's worth, we'll make the process simple. No listings, no showings, no waiting. Just a straightforward offer and a fast close. Back to 1031 exchanges. One common mistake is not doing enough due diligence on the replacement property. Just because you're avoiding taxes doesn't mean you should buy something that won't perform. You need to look at location, market trends, tenant demand, and other factors to ensure you're making a smart investment. This is where having a trusted property management partner can make a big difference. Financing can also complicate things. If you're using a mortgage to buy the replacement property, the loan must be equal to or greater than the mortgage on the original property. Otherwise, you could end up with taxable boot. Working with lenders who understand 1031 exchanges can help you navigate these challenges. Another important consideration is market timing. While 1031 exchanges are a great tool for deferring taxes, they don't guarantee that the replacement property will increase in value. That's why it's essential to understand market conditions and make data-driven decisions. Alpine Property Management. Kansas City can provide valuable insights to help you choose the right property. Thanks for watching. If you found this video helpful, please like, share, and subscribe for more real estate tips and strategies. And remember, if you're ready to sell a property, Alpine Property Management Kansas City is here to help. We buy houses, making it easy for you to focus on your next investment.